Welcome to our new advisor education series with AMP Capital, where a financial advisor puts AMP Capital's brains to the test when it comes to investing. Today's agenda: Australia's first actively managed multi-asset fund that's traded on the ASX. So let's join in on their discussion.
Over the last 12 months, there's been a lot of new products that have been launched in the market. AMP Capital have actually recently just launched DMKT. What is DMKT?
So basically, the Dynamic Markets Fund, or DMKT, if you look at the exchange-traded version of it, gives you access to around 80 potential trades globally in just one trade. If you look at all the studies, they show that what's most important to investing is the asset allocation decision, what you've got in each particular asset through the course of the business cycle. And as time's evolved, we've come into a lower return world, more volatility. The importance of asset allocation, I think, has grown, so the Dynamic Markets Fund effectively focuses on the asset allocation. So it gets exposure to a range of assets using low-cost vehicles such as exchange-traded funds or futures, or in some cases index funds. So that helps keep the cost down, but we significantly change the asset mix, if you like, dynamically through time.
Does the fund outperform a benchmark or track a benchmark?
Well, if you look at the tradition of funds in the investment management world, they're all aimed at outperforming benchmarks. The problem with that is that those benchmarks are often like, let's outperform the ASX 200. And if you go through a year where the ASX 200 falls by 20%, you say you've only fallen by 18%, you've outperformed, but the client, of course, still got a big fall. So what we've done with this fund is tried to outperform an objective, and that objective is what you might call an absolute return objective. It's basically inflation, so that's the rate of inflation, plus 4.5%. And it aims to outperform that objective over the course of time, particularly over 5 years.
The unlisted fund has quite easily done that since inception. If you look at the performance of markets since the global financial crisis, there's a lot of divergences. Some areas of the market have become clearly expensive, whereas some areas of the market have been totally forgotten and really cheap. So if you're going to invest in markets based on headline benchmarks, it's hard because you're constrained. Whereas if you lift those constraints and target cheap markets, which there's plenty of them in the world right now, and there are a lot of opportunities, but you have to be very selective about it. If you own the market, you can just go to your broker and buy or sell your holdings at a press of a button. Whereas when it comes to an unlisted fund, obviously there are more processes involved to transact.
Is DMKT more volatile because it's listed?
It's not, because if you look at the exchange traded managed fund, the market, its holdings basically reflect the holdings of the unlisted fund, which are all listed. The market is priced to NAV every 15 seconds and net asset value. So there's an INAV in the portfolio, which is intraday net asset value, which reflects the value of the unlisted fund, and that refreshes every 15 seconds. In a sense, even though there is more liquidity in the market, it doesn't come with high volatility.
Thanks for tuning in to AMP Capital's Advisor Education Series. Be sure to check out part 2 next week, where we'll explore how DMKT works.